right, next on our agenda, consideration of the September 30th, 2024 report of Lake County pooled investments. And we have Mr. Sullivan, our treasurer tax collector, and Carlos. Sorry, I only have the first name.
It's all right, it's hard to pronounce.
Welcome.
Thank you. Patrick Sullivan, treasurer tax collector. I'm here with Carlos from Chandler Asset Management. We're going to present.
Please turn on the mic. Should go green.
Oh. So Patrick Sullivan, treasurer tax collector. I'm here with Carlos Oblitas from Chandler Asset Management. We are here to present the September 30th report on investments. And at this point, I would turn it over to Carlos for the presentation. I can put it up. Yeah.
So the materials get pulled up, supervisors. It's great to see you again. Happy holidays to everybody. I'm going to keep it brief because you're probably running behind schedule. I think that if we have the presentation up, I think it might be best to, before we jump in, just start by saying that the size of your total overall investment program, just as a reminder, let's go back to the ABCs. The size as of September 30th was $520.4 million. This includes everything. It includes 2 portfolios that are managed by Chandler Asset Management and a host of cash management investments spread out amongst investment pools, money market mutual funds, bank accounts, and savings accounts. All of it functioning in conjunction with one another to, again, provide liquidity to pool participants when they need it, to ensure that the investments are safe, and of course to generate a competitive return. So the total amount is $520 million. Of that $520 million, $77.6 million as of September 30th is in those liquidity vehicles. That's not managed by Chandler, but it is managed directly by your treasury and your treasurer tax collector. And then Chandler handles 2 portfolios. The portfolio that we call the core or longer term portfolio, about $375 million, and then a smaller liquidity portfolio that we've been managing as an alternative to the state pool. That one titles about $67.6 million for a total of $442. So of that 520, we're managing about $442 million on your behalf. So I want to focus on that longer term core portfolio. And if we turn to page number 16, I want to show you what it looks like. A reminder, when we set up the strategy for this portfolio, the main strategy was to maintain the investments between primarily 1 and 3 years. We go a little longer sometimes, a little shorter, but sometimes whether we do that or not, the bulk of the investments stay between 1 and 3 years. They average somewhere around 1.7, 1.8 years. That's important. That strategy has been done because we get a level of expectation for the volatility of returns when we do that, and we also get a level of expectation for the kind of return we're going to get over the long haul. That approach for those $375 million that you see up there, as of September 30th, the yield to maturity, or rather the income that you are expected to earn on an annualized basis into the future, was 3.51, a little bit higher than what you saw the prior quarter. But I want you to look at the market yield, which is the row right beneath that. The market yield on this portfolio is 4.08. It infers a reinvestment rate, which means that we're still picking up some very robust yields. That is also down from the prior 3 months because interest rates in the markets have come down. The Federal Reserve has lowered interest rates. That number, that reinvestment that's inferred, was in the tune of about 5.02. So you can see that we're reinvesting approximately 100 basis points, 1% lower than we were three months ago, and that's simply because of what the Fed has been up to in lowering interest rates. This portfolio is has a very, very high credit quality, and as I stated, it averages about 1.7 years. If we go to the next page, on page 17, the backbone of this portfolio is the diversification that we've introduced. We try to take advantage of every asset class that's available to us under California government code. Treasury and agency securities, these are obligations from the United States government and its federal agencies. That continues to be the backbone of all of this because those are considered the most liquid and generally the safest investments. But we add yield advantage sectors to the portfolio to add yield over the long run. And we diversify those. And that's a dynamic approach. So, for example, through September 30th, Treasuries made up about a third of the portfolio, 33%, almost 34%. Federal agencies made up a little bit over a quarter of the portfolio, 26%. High credit quality corporate bonds make up around 24, a little less than a quarter. The results of that can be seen on page number 20. Over the past 12 months, ended September 30th, the return on this portfolio. So this is a combination of interest income that was earned during the last 12 months and also the change in fair value of the investments. When you combine them together, we get a total return of 6.96%. You did really well. We haven't seen returns like this in 15 years. Very, very good return. Versus the benchmark, which we use to gauge the amount of risk that we're taking on in the portfolio, and we also use that to measure how our returns are doing versus the market. Well, the return on the benchmark was 6.74. So you outperformed it. Why is that? Primarily because of the diversification that you had in the portfolio. You have asset classes in there that were not present in the benchmark, which added to the return. Since we've been managing this particular portfolio, that goes back to November 1st of 2021. That was like in the heart of the pandemic when rates were zero, literally. You've been averaging 2.15 per year versus the benchmark of 148. Over the last 2 years, you've been averaging, and that's per year, 2.15 per year. Over the last 2 years, you've been averaging a little bit over 5% per year. So you've done all right. The shorter portfolio, that's the liquidity portfolio. I mentioned that we managed that as an alternative to the state pool. That was done on a temporary basis because there was an inversion of the yield curve. That's a fancy term for saying that there was an anomaly in the term structure of interest rates where you could earn more with shorter investments than you could with the longer. That's usually not the case. We did this tactically in conjunction with your treasurer. We moved approximately 67. The treasurer moved over approximately 67, actually at one point it was closer to $75 million into the shorter term portfolio. We really didn't get much longer than 3 to 6 months on average. That portfolio focused primarily on U.S. Treasury securities, so we kept it very clean with the safest and most liquid investment. That portfolio, if we turn to page number 25, we can see the return over the last 12 months ended up being 5.46. Another strong return for virtually almost overnight cash. So you did well here. Since we began that's been running since April 1st of 2023, so a little bit longer than a year, about a year and a half. You've been averaging an annualized return of 5.4. All right, the key things that are driving all of this, I think it's worth saying, is that the economy is slowing down. The reason the economy is slowing down is because we've had high interest rates. The Federal Reserve raised interest rates, and we can actually see that on page number 12, the chart on the right-hand side. We saw the Federal Reserve raise the overnight lending rate between banks to basically make it more expensive for banks to borrow from one another, which in turn the banks make it more expensive for you to borrow from them. And it's more expensive to borrow money today than it was 3 years ago. And they do that to basically cut people out of the markets when, for example, when you're a homeowner or a home buyer, I should say, you're somebody who wants to invest in a home and you want to borrow money to buy that house. Well, if the mortgage rate is much higher, that might make you not be able to afford that mortgage payment. So you probably sit and wait and hold your money. And while you sit and wait and hold your money, you're not demanding that house, which hopefully brings the price down. And that's what they were trying to do. They were trying to bring overall prices down. That's inflation. There's a chart on that, which I do want to highlight. That can be found on page number 6. And you can see the consumer price index in June of 2022 reached a 40-year high, over 9%. They wanted to bring that back down, and that's what they've done. They've been fairly successful. They did that by raising interest rates. And now that we're at a point where inflation is lower and the Federal Reserve has maintained interest rates high, the economy has slowed down as a result of that. And now they're doing the opposite. Now they're trying to stimulate the economy to make sure that they give enough stimulus to allow the economy to pick back up, but not to bottom out. Okay, they don't want it to bottom out and maybe go into a contraction. So as a result, now they've reversed. If we go back to that chart on page number 12 on the right-hand side, if you just look at the far right-hand side, you see the hike, which is when they raised rates. It looks like a hockey stick, and then they stayed high for a while, and now you see it starting to come down. And that's what they've done. They met in September. They lowered that overnight lending rate between banks by 0.5%, 50 basis points. They met again November 7th and lowered that rate once again by 25 basis points, a quarter point. They will be meeting on September 17th and 18th, or December 17th and 18th in about a week. And it is expected, though not guaranteed, that they may lower rates yet again. And as we enter into 2025, they are on an easing mode, meaning that they're more want to lower rates than to raise them, simply because they want to make sure that the economy doesn't bottom out. So what does it mean for you? It means that for you, your reinvestments, when they raised rates, hit some really high yields, which have benefited you, which have benefited the participants of the pool. Your apportionments have been at the highest you've seen in many, many years. You won't see them as high as they've been. You hit some real high highs. You won't see those coming into next year, although you should still see robust yields, which should still be a significant revenue source for the county and the pool participants. Through this time, we'll continue to navigate. We'll continue to coordinate with the Treasurer Tax Collector. That component that the Treasurer Tax Collector manages directly, that was done tactically to capture some very high yields in that anomaly that I talked about. That's been very successful for the pool. Very, very successful. The utility of that is now waning. And like I said, we continue to coordinate with the Treasurer Tax Collector to make sure that when that inflection point comes, that we've already shifted into a new tactic to be able to maintain safety, liquidity, and return. With that, I'll take any questions you may have.
Supervisor Pyska?
So then we won't see as many gains, but we will see a leveling off. We're not anticipating any drops. Just to be clear.
Correct. Let me take it real technical. Your return comes from two sources. It comes from the interest income that you earn. A bond is a loan, and you're lending money out to these entities. When you buy a treasury bond, you're lending to Uncle Sam. Uncle Sam pays you interest. So interest is part of your return. The promise of that return plus the return of your principal, because it's a loan, you get your money back. The value of that stream of cash coming back to you, it has something called a present value, and that value goes up and down in the markets. So that's the other part of your return. When I think of the word gain, I think of that change in fair value. But I think what you're referring to is the net amount that we're going to end up with. It's not going to bottom out. No, that's not what we're foreseeing. We think it might be a little lower than what you had this year, but it's still going to be robust.
I'm just talking about the graphs that we all love and what that will look like maybe next year and the year after.
I think it'll look competitive.
Any other comments or questions? Mr. Sullivan, did you want to add something before?
Yeah, if you don't mind, I can run through the two remaining charts, and then we can circle back. So this is the quarterly earnings for the pool since we began the comprehensive investment program. So as you can see, we're continuing to have these gains each quarter. This last quarter, and there may have been an error in the memo, it was the quarter ending September 30th, Q1, that was 5.3 million in returns. So yeah, I think what we're seeing, and I think what Carlos was talking about, I just want to make it clear, is that the income at this point, as we have bonds and other instruments continue to mature, we're no longer picking up the huge gains in returns that we were. Each time there's maturity, we were investing at, like you was pointing out, the 5% level or higher in some cases. Our pools have dropped. Our return on our money market has dropped. So at least on the treasury side and the more liquid side, those are starting to really level out, or in some cases decrease as our other maturities come due. Some of them, those older notes that we held at those lower rates, they are being reinvested at a higher rate. But last year they would have been reinvested at 5%. Now they're going to be reinvested more in that 3.5 range. So we're basically, the gains we're picking up on these notes, some of them are still in the 1% to 2% range or even less. So it's going to go up, but it's no longer going to go up even on those in the way that you saw in this last year. So if anything, if there's any more gains to be had, it's going to be pretty slim. Otherwise, I mean, at least from the perspective that I'm seeing, I think by the end of next year, if rates don't change, we're really going to have leveled off. Okay. So So there's this chart, and then also just for your awareness, I think it's too much to really go through here, but this is historical apportionment data that your board has requested in the past. This also goes back to 2021. This shows the per fund breakdown of how the investment earnings for the county from the Treasury pool were apportioned. So just if you look at the first one, for example, general fund, it was like $288,000 in 2021. For 2024, it's $3.4 million. If you go to the final page, you'll see that total breakdown of interest earned back to 21, and you can see the trends and changes there. And it may just be of some value for what some of the questions your board had to understand how these investment earnings impact not just the county, but also the school districts, fire districts, and all of our partners throughout the county. So if there are any questions, I'm happy to take them.
I see no questions or comments. I appreciate you providing the level of detail, and hopefully now it's a simple report to run, so it's not something that you have to do from scratch as you had to in the original time that you brought that to us. But seeing that change and making it very public as to all the different agencies and what they're benefiting from this, seeing us start from about $90,000 per quarter, going all the way up to 5.3, 5.4. We're looking at 60 times the level of investment return that we were getting on a quarterly basis. So that's pretty awesome. I don't know what other word to use other than it's really fantastic. I know that we also just in our consent agenda just approved no changes to the policy. And it sounds to me, based on the words that you expressed, that our policy is working for us better than it may be working for others, as we're looking at kind of the state average, and we're looking at, or what your, forget what the term was that you use. I don't have, but basically like your standard of what you expected for the percentage gain, and we seem to be above that. And part of that could be what's built into the policy, because we have certain limitations on where we can invest and where we can't invest. So I don't have questions necessarily about the policy because it seems to be working very well for us. But is there a point in your duties where you come to us saying something's wrong with your policy? Others are doing 5%. You seem to be dropping down to 2%. If we changed it and were able to invest into these specific criteria of investments, we would do a whole lot better for you rather than waiting on an annual basis. Just kind of wondering what the future might look like, because everything's changing at all times, right?
Yes, I can answer that question. The policy, as you stated, is robust, and when we launched this investment program, there were a lot of it was a very collaborative approach to make it robust, if you remember, and there was quite a bit of education on the investment side to understand what we were adding to the policy. I would tell you that the policy is robust because for three reasons. Number one, because it expanded the asset types that you're allowed to purchase that are allowed by California government code. Prior policies did not do that. So that was one major shift which put you in this territory. You're not just earning more money because of that, you also are earning higher money. We can't take all the credit. Interest rates are much higher today than they were when we started. But the policy allowed you to capture those in a diversified manner. The second reason the policy is robust is because it follows code. It was a concerted effort to make sure that whatever parameters we put in there, they did not violate California government code. Code severely restricts what you're able to do. The third reason your policy is robust is because it includes best practices that we've included in there based on the different industry groups that are out there, our 36 years of experience that we've had managing money, all the things that we've seen, they're all in there. So they're designed to kind of keep you safe, to protect you, because there's a lot that you can do that can really do damage to the portfolio. Your question was, at what stage do we come back and say, do we change the policy? I would say that the policy at this stage, the changes that would come about wouldn't necessarily catapult you into another new level of earnings. That's already been done. At this stage, the changes are more if we're observing trends in best practices that shift that we think are good to adopt, or if there's a change in California government code. And indeed, we communicate pretty regularly on changes that are coming. We just had one for this year. Senate Bill 882 just did a reclassification of federal agency mortgage-backed securities can be treated as federal agencies. It was a gray area of California government code. Code clarified that. The good news is that you are already interpreting it that way in your portfolio. No change needed. But those are the types of changes that I would anticipate. None that would maybe catapult or change the earnings profile of what you're doing.
And I appreciate where we've started, and I don't anticipate we will ever go back to the 80 or 90 with this level of policy. I think that investment is always going to be a bit of a roller coaster ride, but I don't anticipate to drop in the same way from where we started. I'm looking forward to looking at the overall trends after years of continuing to follow the same policy. So thank you so much. All good news. Every time you show up, there seems to be good news. So let's try to keep that trend going.
We'll keep working on that.
Supervisor Green?
Yeah, probably my last investment pool report, and so I'm going off the board as is Supervisor Simon, and I just want to take this opportunity to thank you. I don't think I'm any smarter after listening to your reports, but I feel smarter, and that's the important part, I think. I mean, I almost felt like, do you have a podcast? I want to follow you. So I'm not going to follow the board meetings verbatim after January, but I appreciate so much the granular detail you bring to this, but also the enthusiasm. And I think you've been a great asset, along with our treasurer tax collector, in shepherding us toward financial stability and growth for us and our partners. But that's just it. Thank you. I appreciate everything you're doing.
Thank you, Supervisor. It's been a delight to work with.
All right, let's go ahead and open up for any public comments regarding this item. Please come up to the microphone, raise your hand in Zoom.
Michael Wagner. Thank you, everybody, for being here today. I actually just had a question, so I could maybe understand, make sure I totally understand what we're looking at. The two portfolios that are handled by Chandler, you guys had some graphs of that from June to September. Is that right? You know, we were flipping through those things so fast, I could hardly keep track of it. Would you mind pulling it up for me? There was one for 400,000.
What was the question that you had for this?
I was just trying to take a look at what between June to September, what our changes were. Is that okay with you guys?
And it's on our website. It's there. The attachments are all there. If you just wanted to review, you have access to that.
Okay, you guys had a chart that showed from June to September, and it had the full amounts. You know, the starting and ending amounts.
I'm just trying to figure out what your question is regarding those amounts.
I was just trying to see if I'm following correctly. I'm not sure if I have a question. I just wanted to see what the beginning in June to right now or September's amounts were in the two portfolios.
Okay.
As we were going through.
And like I said, I just don't want you to control what staff is going to show on the screen when it's available to you to look at, and if you have further questions, because this is not a.
I'm not trying to control.
No, but you're asking to bring up something. But if you don't have a question, it's available. You can look at it. If you have a question, let's get the question. And
so my question, until it went off into oblivion, right there was there. If I could see the full amounts of what I'd started at to what it is now, it just looks like from June to September, there was a substantial loss, and I was wondering if he would be willing to help us understand what was going on in the markets that would affect that.
Thank you for the question.
So I think what you're referring to is the total market value at the bottom where. Correct. I think what you're referring to is the total market value at the bottom, which is the market value of the portfolio, including accrued interest, which is interest that you've earned to that point but not yet received. It's attributed to you, but it just hasn't hit your account yet. That is not a loss. This program also the change in value there is due to a withdrawal that we had. There's dynamic withdrawals that happen periodically out of this portfolio. So there's not only is the portfolio balance moving around because of an increase in value from investment activity, but there's also money being pulled out to pay for things. participants. Sometimes it's a pool, so there's more people in the county than the county in the pool. So there are participants which have liquidity needs that they'll have to pull money out of that pool to make payments for their obligations. Right now, the opposite is happening. We have a run up to December 10th, which is today, where people are paying their property taxes. So there's a lot of money coming in, and that money may flow into any number of these places. Typically, it'll flow to the liquidity vehicles that I spoke about that the Treasury manages directly, but some of that may get shifted to the longer portfolios. The intent of the portfolios is that you have money that generally isn't needed, but sometimes it is needed, and the county will pull money out of there. So that wasn't an actual loss. The portfolio actually grew for that 3-month period. The portfolio actually grew for that 3-month period 2.77% from investment activity. There was just a shift because people pulled money out.
If at this moment in time, if you want to meet with Mr. Sullivan to continue the question, at this point, we're done with the conversation. If you want to go back and forth, please make sure to talk with Mr. Sullivan, and Carlos may be around as well. Any other comments or questions? All right, seeing none, and I'm trying to stay on time for some of our other items that we're already behind on, especially with some of the issues that we've had to deal with. I'll bring it back to the board. If there's nothing further, thank you very much for your time. Thank you for the good news. Let's,
Move to accept.
oh, yes.
So moved.
We have a motion and a second to approve the report. All in favor?
Aye.
Any opposed? Motion carries. Thank you very much.
Thank you.